Hi, so in the previous video we looked at what happens when we have shocks to productivity in our goods market equilibrium, but that was not necessarily very representative of what happens in real life because we didn't have investment in our model. Investment. So that is what we're going to add to the model in this video because investment accounts for up to 90% of fluctuations in business cycles, as has been found in empirical studies of this, so we really need to have investment in our model if we want to accurately model an economy. So how are we going to add investment to our economy? Well, first we're going to add it to our aggregate demand function. So we are going to have an aggregate demand function, which is our demand for output in period 1. Previously we just had this consumption function in period 1, but now we're going to just add to it investment demand as well, and that becomes our demand for output. We add investment in there, and we're going to have an aggregate supply relation still, which is similar to what we saw in the previous video, but we are going to have capital as well as labour in this one. So we have some function of labour in period 1 and capital in period 1 multiplied by our productivity parameter A in period 1, A1. We are also going to make another assumption in this model, and this assumption is going to be that we have some time to build. Call this a time to build assumption. What does this mean? It means that when we invest in one period, it's going to take another period in order to build this capital that we've invested in. So say we invest in period 1, we're only going to get that capital to actually use it in period 2. It takes one period to build the capital. So if we write this out as an equation, it says that our capital stock in period 2 is going to be equal to our capital stock in period 1, but some portion of that capital stock is going to depreciate, and the fraction of the capital that depreciates away is given by this delta parameter, and that's very similar to what we saw in our solo growth model. And then our capital stock in period 2 is also going to be depending on how much we invest in period 1, this I1 term. So by investing in period 1, we increase our capital stock in period 2. It takes one period for that investment to turn into capital stock. What we are going to also assume in this model is that this K1 term is just given to us. It is given, or we could say it's exogenously given. So our only thing that we're actually concerned with really here is investing in period 2 capital. We're not really worried about altering our capital stock in period 1 because we can't. That is determined in period 0, but we're in period 1, so that is in the past, so we assume that it is exogenously given. A further assumption we're going to make is that firms can borrow at the nominal interest rate R. You'll notice that this R is the same as the consumption interest rate, which we could think of this as consumption R. This is what individuals save and borrow their income at, but we're going to assume that firms have this exact same interest rate. Obviously, in reality, businesses and individuals borrow at different interest rates, and there are loads and loads of different interest rates in an economy, but it makes our algebra and our calculations a lot simpler if we assume these are all equal in our model. And finally, we're going to make a perhaps more realistic assumption that we have diminishing marginal returns to capital. And as I said, we're only really worried about capital in period 2 because we can't change our capital stock in period 1. So let's write out what our marginal product for capital in period 2 is. We have this function. It is going to be the derivative of our output function in period 2 with respect to the capital stock in period 2. So here above we can see this function in period 1, and that is fine for us for our aggregate supply in period 1, but if we want to think of marginal product of capital in period 2, we are going to take the derivative of this function in period 2. So we have this depends on labour in period 2 and the capital stock in period 2. And that is a derivative. So we have diminishing marginal returns to capital. This should be a pretty familiar equation. If we just take the derivative, say, of a Cobb-Douglas production function, we would get out this as our marginal product. So, okay, how can we use this? What we want to now figure out, now that we have this marginal product of capital, we want to know how do we use this function to determine what our optimal demand for capital is in equilibrium. So to derive what our optimal demand for capital is, or what our firm's optimal demand for capital is, we can consider, just for simplicity, that we have £1 that we can spend as a firm. And we have this £1 in period 1, and we want to get as much return as we can in period 2. So as we said before, that firms have some interest rate that they can save and borrow at, which is just R, the same as the consumption interest rate. So a firm could put this £1 in a bank and earn interest rate R, and they get out in period 2 their £1 back plus interest R. So that is one way that this firm could use their £1 that they have, that they can invest. Or alternatively, they could invest this in capital. They purchase capital in period 1. But what we know is that it takes time to build. So in period 1, you're just spending that £1 on capital, and we only reap the returns of this in period 2. What do we get back in period 2 from this £1 investment? Well, we get our marginal product of capital. This is what our machine earns in that time. It's just £1 multiplied by the marginal product of capital. But after our machine has produced that, we still have a machine. So we don't just get out the marginal product of capital, we get back the value of a machine in period 2, which is the £1 value of the machine that we bought minus however much the machine has depreciated over time, which is our depreciation parameter delta. So for example, if you bought loads and loads of machines today and they produced for one period, you'd get back their marginal product, but you would still have that machine which could then produce in period 3, period 4, period 5. And what is the value of that machine and its future production? Well, it is 1 minus the depreciation rate. So these are the two possible returns we could get. We could bank the money and get back £1 plus interest, or we could get our marginal product of capital and the value of the depreciated capital. So, okay, in Optimum, how are we going to use this information to get our optimal demand for capital? Well, at Optimum, these two are going to be equal. Why is this? Well, let's think about this. The fact that no matter how much capital we invest in, this term, this £1 plus R, is going to be constant. This is always going to be an option that we have. No matter how much capital we have, we could always just invest in a bank and get back our investment plus the interest rate. However, as we increase K and we increase K and we keep increasing further and further, we have diminishing returns to capital. So our marginal product of capital is going to fall as we increase K, and so this whole term is going to keep falling and falling. So it gets to a point where this marginal product of capital that we get back is going to be less than what we could earn in a bank. So why would we invest in machines when we could just get a better return from a bank? We're not going to do that. So that means our optimal demand for capital is the point where these two terms are equal. We're going to keep investing in capital until it makes more financial sense for us to invest in a bank. So we can just set these two terms equal to each other, and it says that we'll have our marginal product for capital plus 1 minus depreciation is equal to 1 plus R. At our optimal demand for capital, we can clearly subtract these 1s from both sides, and then we can add across this depreciation term to the other side, and so we get that at optimum, our marginal product of capital is equal to the interest rate plus our depreciation parameter. If we want to solve for the exact optimal level of capital, we can use the fact we know what our marginal product per capital equation is. It is simply A multiplied by the derivative of our function of labour and capital. And so this is a derivative, and it's equal to r plus lambda. And once we know what this function or our production function is, we can rearrange and get k equal to something, and that k level is going to be our optimal level of capital, and that's how we solve for it. We could also instead show this graphically. So I will draw up a graph. Let's get some axes down. Okay, so what is our y-axis going to be? Well, we can write marginal product of capital and our level of capital on the x-axis. So if we look here, this is what our optimal condition is going to be. Our marginal product of capital is going to be the interest rate plus depreciation rate. So we can draw the left-hand side and the right-hand side of that on this set of axes. So we have a downward sloping marginal product of capital curve. Why is that? Well, as we said, as we increase our level of capital invested, our marginal product of capital is decreasing. We have diminishing marginal returns. So this marginal product of capital is, of course, equal to this derivative, which I've written down plenty of times. And the right-hand side of this equation, as we have above, is just that this constant, this interest rate plus depreciation rate. And as we've said, at optimum, these two are equal. So at optimum, we have some optimal level k star. This is our optimal level of capital where we set these two equal. So why have I drawn this out on this graph when I already showed how we could use this result to find our optimal level of capital? Well, this means that we can quite easily see what happens when we change our parameters in the model. And once we change our parameters, what happens to our optimal demand for capital? So, for example, what happens if we increase our interest rate R? Well, the interest rate enters into this constant or horizontal curve here. So if we increase it, we are going to simply be, that is a terrible line. We are going to be shifting up this horizontal curve here to, say, R1 plus depreciation rate, where R1 is greater than R, and we see we have a new optimal level of capital, K star 1, and this is lower than our original level of capital. So if we increase the interest rate, this is going to decrease our optimal demand for capital. And very similar for increasing the depreciation rate, you can see that it's exactly the same thing. If we increase depreciation rate, we're going to be shifting up this curve. So again, increasing depreciation rate will decrease our optimal demand for capital. And our third and final parameter that comes into these curves is our productivity parameter. So let's imagine we increase our productivity parameter A. Well, this factors into our marginal product of capital curve. So if we increase that curve, we are going to be increasing our marginal product of capital, which we can show as a shift upwards or a shift to the right of this curve, this marginal product of capital curve. We'll call it marginal product of capital 1. And we get this new point all the way over here. And so what we see from that is that if we increase our productivity parameter A, we are going to increase our optimal level of capital K star. So what does this tell us then? Well, let's go back and see why we've done this long and arduous exercise. Well, let's go back to our time to build equation, where we said that the capital stock in period 2 is equal to the capital stock in period 1 after it's been depreciated, plus our investment in period 1. But what we want from this model, the whole idea was that we were getting some function of investment or investment demand that we can add into our model. So let's rearrange this term so that we get investment 1 on its own on one side, and we're going to call this investment demand. Well, this is going to equal to our demand for the capital stock in period 2 minus our depreciated level of capital stock in period 1. So I've simply just subtracted this 1 minus delta K1 from both sides to isolate investment in period 1 on the left hand side. But what we want is an investment function that depends on a number of parameters. We want an investment function, and we want to say how that changes with our parameters in the model. So we could say shift this curve if we have a change in productivity or a change in interest rate or whatever. So what we've shown above on this diagram, well, we could just write that this x-axis, we're looking at optimal demand for K2. And so all of these changes we've looked at, let's say we've increased the interest rate, well, this decreases the optimal demand for K2. And we increase depreciation rate, again, decreases the optimal demand for K2, and increasing our productivity parameter A is going to increase the optimal demand for K2. So now in our investment equation, we have our demand for K2 is going to depend on the interest rate, the depreciation rate, and the productivity parameter A. It depends on all of these in period 2, but we're going to assume that our interest rate and our depreciation rate are fixed, so I won't subscript to those with the time in period 2, but we don't necessarily assume that our productivity parameter A is fixed over time, so I'm going to subscript that with a 2 here. And as we showed above, this demand for K2 depends negatively on the interest rate, negatively on the depreciation rate, and positively on our productivity parameter A2. Okay, but we have also assumed that this K1 is just some given constant, it's exogenously given by period 0, which we can't control. So this is just some constant, basically. So basically, our investment demand is entirely given by our demand for K2 here. So we can say that our investment demand function depends on the interest rate, the depreciation rate, and our productivity parameter A2. So we now have an investment demand function. To take this one step further and finish off this, we can, from the fact that all we have here is a constant, and we have this term K2, which is varying, it's a function of our depreciation and A2, we can then say that thus our investment demand function depends negatively on the interest rate and depends positively on the productivity parameter A2, because on the right hand side, the only place where we see the interest rate and the only place we see productivity parameter A2 are in this K2 equation. So investment demand is only going to depend on these parameters in the same way that this K2 function depends on these parameters. So we can immediately just write down the relationship that investment has with interest rate and productivity parameter. So very nice. However, you'll notice I haven't said how investment demand depends on our depreciation parameter delta. Now that is because we have this delta showing up in our term over here. And now we've said that K1 is a constant, but this term changes values. If we change our delta term, then this term is going to change, as well as this function K2 is going to change. So to look at the overall effect this has on our investment demand function, we're going to have to weight the impact in K2 demand and on this term at the end of our equation. If we expand out this function that we have at the end, multiplying out the K1 and the minus and this bracket, we see that this function looks like this, minus K1 plus delta times K1. And as we can see, this delta term comes into this expression positively, whereas it factors into the K2 demand function negatively. And a positive and a negative, it means that our overall effect on investment demand is kind of complicated. And so we'll need to know more about this K2 demand function and how that trades off with this K1 function in order to know if a change in the depreciation rate has an overall positive or negative effect on the investment rate. So at this moment in time, we're just going to say that we are not really sure how investment depends on depreciation rate. It is not certain. Luckily for us, we're usually in economics interested in a change in the productivity parameter. We don't necessarily mind so much what happens if we change our depreciation rate, as we kind of assume that depreciation rate is fairly constant and it's not going to change all that much. So we are going to just note down that investment demand in period 1 depends positively on the productivity parameter A2. Increase A2, we're going to increase our investment demand. And we will look at that further in the next video when we look at temporary and permanent shocks on investment demand. So thanks for watching. Check out the playlist for that future video. Do subscribe for lots of other videos, and do drop a like on this video if it was at all useful.